And the Dow Jones last week hit 50,000 for the first time ever, which sounds like cause for celebration. But according to our next guest, big milestones don't change market math, but they often change investor behavior. So for insight on how you can respond during times of uncertainty, we'll be speaking with Midland Financial founder Lawrence Sprung, also the author of Financial Planning Made Personal. Lawrence, great to see you this morning. Big milestones don't change market math, they change investor behavior. What did you mean by that?
Yeah, I mean, things are that every cycle feels different, and 50,000 is definitely quite the milestone, but it's just a number. It really doesn't mean something to an investor who started last month or who's thinking about starting today. So you want to be prepared for the markets and be prepared for that volatility because, with every upside, there's also some volatility. Volatility is the toll we pay as investors. And really, be prepared for those times. And investors who sell during those uncertain times really don't sidestep risk, but they miss a lot of the upside, the best days of the markets.
So right now, investors are focused on rate cuts, recession fears, and the possibility of a soft landing. Why do those narratives often become a trap for investors?
Yeah, because rate cuts, to some can mean support. It could also look at it as there's a slowdown that we need those rate cuts, or it could mean that the market, the economy is stabilizing and markets could react aggressively to each of those interpretations. It really depends on what your feeling is regarding those specific events and how you feel it's going to impact things. Historically, Fed pivots bring volatility, not necessarily clarity, and prices tend to move before the data confirms what actually is going on. And really, at the end of the day, investors who sell while waiting for the certainty often exit just as the recovery phase begins, and that's problematic.
Yeah. You pointed out that the market's biggest up days and biggest down days tend to cluster together. If you could dig into why selling during volatility is so damaging to long-term returns.
Yeah, so if you look at the historic markets and how they've performed, typically some of the best days, as you mentioned, cluster around some of those worst days. Now let's look at the numbers. Since the year 2000, the S&P has averaged about 9.8% annually when investors stay fully invested. Now, you compare that to if you miss just the 10 best days each year, just 10 days, your returns fall to roughly minus 12.5%. So that is a huge swing. So unless you're going to be the person that is going to be able to time exactly when to get out and take advantage of those 10 best days, you can have a huge swing in performance from positive almost 10% to minus 12.5%. That's a big swing.
So research shows investors trade more around round numbers like 50,000. Why do psychological milestones lead people to make worse decisions, do you think?
Yeah, I think we end up trying to justify what we're looking to do, right? If you're on the side of, hey, I think the markets are going to go down. If the markets hit this number, I'm going to enter. Or if it runs away and hits this number. So we end up justifying ourselves out of making a decision in a lot of situations. And really, these milestones just act as psychological anchors, and they trigger fear, greed, and sometimes even overconfidence, depending what you're looking for. And it increases your urge to do something. But here's the story. Round numbers don't change fundamentals. They just simply change the behavior, and emotion-driven decisions are consistently linked to worse outcomes. The better path to take is just be patient and be a disciplined investor. If you have the time horizon, enter, have a diversified portfolio, and stay invested. And when those volatility times come in, take advantage of that. And if you're in a position, add more money at those times instead of running to exit.
So if the real edge isn't predicting rate cuts or recessions, what should investors be doing right now instead?
Yeah, the best thing to approach this is we know volatility will come. Last year, we saw volatility around Liberation Day. It was somewhat short lived. In 2026, I assure you, we will have some event that will cause some level of volatility. And that could come today, that could come in a month, or come in 6 months. But the important thing is have a plan before the volatility comes in play. This way, you have that plan in place and you'll have a way of approaching it rather than reacting to it. And investors who have a plan going into volatility make better decisions when markets get shaky.
I know you're having these kinds of conversations all day long, but is there anything you think is really missing more broadly from the conversation around investing and that could be useful at this particular time when people may be feeling a little unsteady?
Yeah, I think that, you have a lot of question marks and there are always questions. Today it's, will rate cuts fuel growth? Will recession come into play? Will the economy be, continue on the path that it's on, or will it have a soft landing? They're all, whether it's these questions that we're asking today or different questions, there's always those questions. Have your time horizon, have a consultation with an advisor if you don't feel comfortable handling or working this on your own, and have a plan to approach these volatile times. So when and if they arise, because they will, you'll be fully prepared instead of the other P word, which is panic. And then you'll end up missing one, if not several of those 10 large up days, really hindering your growth and your family's nest egg.
In other words, nice and easy does it, in the words of Frank Sinatra. Good to have you with us this morning, Lawrence Sprung, as always.